Look at your most recent retirement statement, the traditional IRA, the old 401k. Look at the balance in the corner. Now, I am going to tell you something that the person who opened that account never told you. That number is a lie. Not the whole number, but a large piece of the money sitting inside that account was never actually yours. It belongs to the Internal Revenue Service. You have not paid the tax on it yet. And here is the part that should make you sit up straight. The IRS gets to decide when that tax comes due and at what rate. Not you, them. They have built a machine that waits patiently for decades and then detonates that tax bill at the single worst moment of your life. The year your required withdrawals begin. The year your husband or your wife passes away. The year your children inherit what you built, at a rate you never agreed to. There is one move that diffuses this. It costs pennies on the dollar right now. And the window to make it cheaply slams shut on the first day of January. This is not about tax rates going up. Rates are actually locked in. This is about a quiet window that closes a little more every year you wait. My name is Kevin. Today I am going to show you the tax bomb hiding inside your retirement account, exactly how the IRS detonates it in 3 different ways, and the one move you can make before the calendar turns to take the trigger out of their hands and put it back in yours. If you are new here, this channel exists for one reason. We read the tax code and the government reports that decide what happens to your money, so you find out before the system decides for you. Subscribe and turn on the bell, because this one could be worth tens of thousands of dollars to your family. Let me start with the lie, because you have to understand it before any of the rest makes sense. When you put money into a traditional IRA or a traditional 401k, you got a tax break on the way in. You did not pay tax on that money the year you earned it. The government let you skip it. But the government does not forgive, it defers. Every dollar you put in, and every dollar of growth on top of it, is money the IRS has never taxed. Not once. Verified card, source, irs.gov. So when your statement says $500,000, a large part of that is not your money. It is the government's money, sitting in your account, waiting. Think of it this way. You have a silent partner in that account, the IRS. You did all the saving, you took all the risk, and that silent partner never put in a dollar. But they own a slice of everything in there. And here is the cruel part. They get to decide how big their slice is by choosing the year and the rate when they finally collect. You would never sign a deal like that with a business partner. But that is exactly the deal buried inside every traditional retirement account in America. Financial people love to call this tax deferred. That is a soft word. The honest word is tax postponed. You did not avoid the bill. You agreed to let the IRS hand you the bill later on a date they choose, at a rate they choose. And for most retirees, later is the most expensive possible time. Let me show you the first way the IRS detonates it. It is called the required minimum distribution. Here is what most people do not understand. You do not get to leave that traditional account alone forever. The moment you turn 73, the government forces you to start pulling money out, whether you need it or not. Verified card. Source, irs.gov, Secure Act 2.0. They make you divide your balance by a number from their table and withdraw that amount every single year. And every dollar that comes out is taxed as ordinary income. Not the lower rate for investments, the full ordinary rate, the same rate as a paycheck. Now here is the trap inside the trap. That forced withdrawal does not just get taxed by itself. It piles on top of your Social Security and your pension, and it can shove more of your Social Security into the taxable zone. It can push you into a higher bracket. It can raise your Medicare premiums 2 years down the road. One forced withdrawal touches every other dollar you have, and the longer you wait, the bigger your balance grows, which means the bigger the forced withdrawal becomes, and the bigger the tax explosion. Let me put a real number on it. Say you reach 73, with $500,000 in a traditional account. That very first year, the government forces out around $19,000. The next year, the required amount climbs, and it keeps climbing. Because the divisor shrinks every year you age, by your 80s, you can be forced to pull out tens of thousands of dollars a year, whether you spend it or not. Every dollar taxed as ordinary income. And remember, you did not choose that number. You did not choose that year. The IRS did. The account you were told to leave alone and let grow is the account quietly building the largest tax bill of your entire life. Let me tell you about Warren and Glenda. They are both 68. They live outside Des Moines, Iowa. Warren spent 34 years as a parts manager at a farm equipment dealer. Glenda kept the books for a small medical office. They did everything right. They saved every year. They never touched it. Today, their traditional IRA holds $540,000. On paper, they feel wealthy, and they should be proud. But that account is a loaded weapon pointed at their own retirement, because Warren and Glenda are sitting in a golden window right now, and they do not even know it. They are retired. Their income is low. The forced withdrawals have not started yet. For a few short years, they are in the lowest tax bracket they will ever see for the rest of their lives. Let me tell you who is standing in that window right now. If you are somewhere between 60 and 72, if you are retired or mostly retired, if your paychecks have stopped, but the forced withdrawals have not started yet, then you are standing in the cheapest tax years of your entire retirement. It is the calm before the storm, and it does not last. The moment those forced withdrawals begin, the window narrows fast, and every year that window sits open, and they do nothing, is a year they can never get back. You cannot reach back next year and use this year's low bracket. When the calendar turns, that room is gone. If this is the first time anyone has explained what is really inside your retirement account, do me one favor. Subscribe and turn on the bell. Because next week, I am walking through the exact ages where this bomb does the most damage and how to see your own detonation date. You will want to be here for that. Now let me show you the second way the IRS detonates this, and this one is the cruelest of them all. It is the one nobody warns you about. It happens the year one spouse dies. Let me tell you about Arlene. Arlene is 74. She lives near Toledo, Ohio. For 46 years, she was married to her husband. He handled the retirement accounts. He always said, "We will deal with the taxes later. Let it grow." Then, 2 years ago, he passed. And Arlene discovered something that no one had ever told her. The year after her husband died, her income barely changed. She still had the pension. She still had Social Security. She still had the same withdrawals. But her tax bill went up by thousands of dollars for the exact same income. How? Because when her husband was alive, they filed as a married couple. A married couple gets wide tax brackets and a bigger standard deduction. The day her husband died, all of that was cut, roughly in half. Arlene became a single filer, same income, half the brackets. Verified card, source, irs.gov. Suddenly, the money that used to be taxed at 12 cents on the dollar was being taxed at 22 and 24. More of her Social Security became taxable. Her Medicare premiums climbed. Let me show you the size of it. While her husband was alive, their income put them comfortably in the lower bracket. The year after he died, that very same income on a single return pushed thousands of dollars up into the higher bracket. And more of her Social Security crossed into the taxable zone. When the dust settled, Arlene was paying close to $5,000 more in tax every year on an income that had actually gone down for the rest of her life. The financial world has a cold little name for this. They call it the survivor's penalty, the widow's tax. Arlene did not earn a dollar more. She simply lost her husband, and the IRS treated that grief as a reason to send her a bigger bill. And here is what breaks my heart about it. There was a window, years before he passed, when the two of them together could have quietly moved that money to the tax-free side at the low married rate. They had the time, They had the low bracket. They just never knew the clock was running. By the time Arlene found out, her husband was already gone, and the cheapest years to fix it had gone with him. This is the part I need every married couple to hear. The move that protects the survivor can only be made while both of you are still here. You cannot do it from a hospital room. You cannot do it from a funeral. You do it now, together, at the kitchen table, or the survivor inherits the bomb. And the engine driving that bigger bill was the big traditional IRA they never touched because someone told them to let it grow. Now, I want to stop right here because Arlene is the exact reason I built the thing I am about to tell you about. For decades, nobody handed Arlene a warning. Nobody sat at her kitchen table and showed her what would happen to the survivor. The rules that governed her own money were written in a language designed to make her give up and just let it grow. That is why I put together a plain English guide called The Quiet Rules. It is the drawer version of everything I cover on this channel. Written large, written simple. The section on this walks a married couple through the exact moves to make while both of you are still here, so that the one who is left behind is protected instead of punished. If you are married and one of you manages the money, this is the paper that protects the other one. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. And there is a 7-day guarantee, always. If it does not help you, you send it back. Now let me show you the third way the IRS detonates this bomb. And this one does not even wait for you to be gone. It goes after your children. Let me tell you about Travis. Travis is 46. He is the son of a woman I will not name because her story is still unfolding. Travis is a good man. He works as a hospital technician. He and his wife earn a solid middle-class income together. Their combined pay puts them near the top of the 22% bracket. Travis's mother has a traditional IRA she plans to leave him. She thinks she is leaving him a gift. She is actually leaving him a tax bill with his name on it. Because of a law that changed in recent years, when a child inherits a parent's traditional IRA, they can no longer stretch it out over their lifetime. They must empty the entire account within 10 years. Verified card. Source: irs.gov, Secure Act. And every dollar that comes out is taxed as ordinary income at the child's tax rate, not the parent's rate, the child's, in the child's highest earning years. So think about what that means for Travis. He is already near the 22% bracket. Pile his mother's IRA on top across 10 years, and much of that inheritance gets taxed at 22 and 24% or higher. A gift his mother saved for decades loses a huge slice to a tax bill she never saw coming and he never asked for. Picture a $300,000 IRA landing on top of Travis's income across 10 years. At his bracket, that inheritance can lose $70,000, even $80,000 to taxes that never had to be paid. The account she thought would take care of her son instead hands a fortune to the general fund of the United States Treasury. So let me put it all together. 3 detonators, 1 bomb. Detonator 1, the forced withdrawals that begin at 73, whether you want them or not. Detonator 2, the survivor's penalty that hits the day one spouse is gone. Detonator 3, the inheritance bomb that lands on your children in their highest earning years. All 3 are wired to the same account, the big traditional IRA you were told to leave alone and let grow. Every one of them detonates on a day the IRS chooses, at a rate the IRS chooses, unless you act. Now, here is the move that diffuses all 3. It is called a Roth conversion, and it is not complicated. You take money out of your traditional IRA, you pay the ordinary income tax on it this year, and you move it into a Roth account. Once it is in the Roth, something powerful happens. It grows tax-free. It is never taxed again. There are no forced withdrawals at 73, ever. Verified card. Source: IRS.gov. It does not pile onto your Social Security. It does not raise your Medicare premiums. And when your children inherit it, they still empty it in 10 years, but they pay 0 income tax on every single dollar. You defuse the bomb by paying the tax now, on your terms, at today's low rate, instead of letting the IRS detonate it later at a rate they choose. Now let me clear up a few things people get wrong about this. First, there is no income limit on a conversion. It does not matter how much you make. Anyone with a traditional IRA can convert. Second, you do not have to convert the whole thing at once. In fact, you should not. You convert a slice each year, just enough to fill your low bracket, then stop. A little every year beats one giant move that spikes your own taxes. Third, and this one is critical, pay the tax with money from outside the retirement account, from savings, from your checking. If you pull extra from the IRA itself just to pay the tax, you shrink the very thing you are trying to protect. The whole point is to move the maximum into the tax-free side. And here's a fear I want to put to rest. People worry that once the money goes into the Roth, they can never touch it. That is not true. The amount you converted is generally available to you, though it is wise to let converted money sit for 5 years before you tap the growth to keep it fully tax-free. Verified card. Source: IRS.gov. But understand the goal. You are not doing this to spend it next month. You are doing this so the money grows tax-free for you, for your spouse, and for your children, untouched by the IRS ever again. Here is why the timing matters so much. Remember Warren and Glenda in that golden low-income window? Every dollar they convert now, while they are in the low bracket, is taxed at around 12 cents. If they wait until the forced withdrawals begin, or until one of them is a single filer, those same dollars get taxed at 22 or 24 cents. Same money, double the tax. The only difference is when they move it. Let me make it concrete. Suppose Warren and Glenda convert $50,000 this year while they sit in that low bracket. The tax is right around $6,000. $6,000 to permanently pull $50,000 out of the bomb forever. That $50,000 never gets force withdrawn, never lands on a survivor's single return at the higher rate, never hands the children a tax bill. Now compare that to doing nothing. If that same $50,000 comes out later during the forced withdrawals, with one spouse gone, filing single, the tax on it could be $11,000 or $12,000. They paid $6,000 now to avoid $12,000 later, and they can do that again next year and the year after. A steady march out of the bomb and into the tax-free side, one low bracket at a time. And there is one more piece that makes right now so important. If this is the first time someone has shown you how to take the trigger back from the IRS, subscribe and turn on the bell, because the system counts on you not knowing that this move exists. This channel exists to hand it to you. Now let me be completely honest with you, because that is what this channel does. For years, salespeople pushed conversions by telling you tax rates are about to skyrocket. I am not going to tell you that because it is not true anymore. The current tax rates were recently locked in, so forget the scare about rising rates. That is not why you act now. And let me ask you something. If this one move can save a family tens of thousands of dollars, why did no one ever walk you through it? Here is the uncomfortable truth. The people who manage that traditional account often earn a fee on the balance. The bigger the balance, the bigger their fee. A Roth conversion shrinks that balance today. There is no product to sell you in diffusing your own tax bomb. So the conversation just never happens. It is not always that they do not care. It is that nobody is paid to hand you the move that costs them. That is what this channel does. We hand you the move nobody is paid to mention. Here is the real reason to act now. There is a special deduction for people 65 and older, worth up to $6,000 each, $12,000 for a couple, that lowers the tax on money you convert. Verified card. Source: One Big Beautiful Bill Act, Section 70,103. But that extra deduction is temporary. It exists only through the year 2028. After that, unless Congress acts, it disappears. So you have a short stack of cheap conversion years, and each one has a hard deadline. A Roth conversion must be completed by the 31st of December to count for that year. Verified card. Source: IRS.gov. You cannot do it in the spring and count it for the year before. There are no do-overs. So the window for this year, the cheap bracket space, the extra senior deduction, all of it slams shut on the first day of January. Whatever you do not use this year is gone. You cannot carry it forward. That is the real deadline. Not a scare about rising rates. A quiet window, closing 1 year at a time, starting January 1st. Now I have to be honest with you about who should not rush this, because I will not pretend this is for everyone. If you cannot pay the tax from money outside the account, be very careful. If you are in your 80s, in poor health, and your spouse will inherit everything anyway, the math may not favor a conversion. And if a big conversion would rocket your income into the range that spikes your Medicare premiums, you slow down and spread it out. This is a scalpel. The people it helps the most are couples in that low window between retirement and the forced withdrawals, with a large traditional account and children who will inherit it. If that is you, this is one of the most powerful moves in the entire tax code. Now think about the arithmetic for Warren and Glenda. If they do nothing, the forced withdrawals, the survivor's penalty, and the inheritance bomb together will cost their family around $63,000 in extra taxes they never had to pay. If they spend the next few years converting steadily in their low window, they diffuse most of it for pennies on the dollar. The difference between doing nothing and making the move is not small. For their family, it is around $63,000. That is a car. That is 2 years of care. That is a grandchild's education. Warren and Glenda did not know any of this a year ago. They were the couple who felt wealthy, looking at that big balance with no idea a silent partner was sitting inside it. Once they saw it, they did not panic. They simply started. A steady conversion every year in their low window. They are not trying to do it all at once. They are walking their money calmly from the taxable side to the tax-free side, 1 year at a time, so that whichever one of them is left behind and whatever they leave to their kids is protected instead of punished. That is the whole game, and the plan to capture it is exactly what the Quiet Rules lays out. The order to convert in, how to size it so you do not accidentally raise your own Medicare premiums, the exact words to say to your account custodian, and the questions to bring when you sit down with a fee-only advisor. Think about the trade for 1 second. The guide costs less than the tax on a single day of delay on an account this size. If it helps you diffuse even part of this bomb, it pays for itself hundreds of times over. You can find it at kevinexplains.shop. The link is in the description and pinned in the comment at the top, or scan the QR code on your screen right now. 7-day guarantee, no questions asked. Now let me give you the exact steps to take before this year ends. Do not let this sit. Step 1. Pull your most recent traditional IRA and 401k statements. Add up the total. That number is the size of the bomb. Step 2. Estimate your income this year before any conversion. Your pension, your Social Security, any withdrawals. You are looking for how much room you have in the lower brackets before the year ends. Here is a quick way to feel the danger. Take your traditional balance and divide it by by 26. That is roughly your first forced withdrawal at 73. Now imagine that amount landing on your taxes every year on top of everything else and climbing as you age. If that number makes you uncomfortable, that is the bomb talking, and it means this window is for you. Step 3. Call your account custodian and say these words. I want to do a Roth conversion before December 31st. Ask them how much you can convert without jumping into the next bracket. Step 4. Do not convert so much that you spike your income and raise your Medicare premiums 2 years from now. This is a scalpel, not a shovel. A steady amount every year usually beats one giant conversion. Step 5. If you are married, plan this together while you both are here. The whole point is to protect the one who will one day file as a single. Do not leave the survivor holding the bomb. Step 6. If someone you love, a parent, an aunt, or uncle, has a large traditional account and thinks they are all set, sit down with them. Many of the people holding the biggest bombs are in their 70s and 80s and have never once been shown this move. An afternoon of your time could save your family tens of thousands of dollars. Step 7. If your situation is large or complicated, sit down with a fee-only advisor, the kind who charges a flat fee and does not sell you products. One honest hour can protect a decision worth tens of thousands of dollars. And if you want me to look at your situation myself, email me at kevinexplainsofficial@gmail.com. I read every one. Now let me bring this all the way home. That balance on your retirement statement is not all yours. A piece of it has always belonged to the IRS, and they have built a machine that waits and then takes their piece at the worst possible moment. When you are forced to withdraw, when your spouse is gone, when your children inherit, at a rate you never agreed to. But you are not powerless. For most of your life, this account controlled you. The rules, the deadlines, the rate, all decided by someone else. But right now, in this short window, for the first time, you hold the trigger. You can take it out of their hands. You can pay the tax on your terms at today's low rate and hand your family money that is truly theirs. Not a balance with a hidden partner attached. Real money, tax-free, forever. And understand how final this deadline is. A conversion cannot be undone, and it cannot be done late. There is no filing an extension. There is no fixing it in April. It happens by December 31st, or it does not happen for this year at all. The window for this year closes on the 1st of January. Whatever you do not use is gone. So do not wait. If you have a traditional IRA or an old 401k, do not let the IRS choose the day and choose the rate. You choose while you still can. Send this video to the couple you know who have a big retirement account and think they are all set. They are not all set. They are sitting on a bomb and nobody ever told them. You might be the one who hands them the way to defuse it. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.